Hi there, John Bowens with Equity Trust Company. Welcome to our Facebook Live session talking about how to potentially save $10,000 on your next real estate investment transaction. Now, I'm here to talk about one of the most powerful wealth creation tools afforded to us by the federal government, and that's a self-directed IRA, particularly a self-directed Roth IRA. Now, there are many self-directed accounts that you can take advantage of. And if you want to learn more from Equity Trust Company, you can talk about those various tax-exempt accounts. But in this session, we're going to talk particularly about the Roth IRA. And in just a few moments, I'm going to share a hypothetical case study with you on how you potentially save $10,000 on your next real estate investment transaction. Now, first, let's talk about what is a self-directed IRA. Most Americans are unfamiliar with what a self-directed retirement account is. In fact, less than 2% of Americans are using these secrets, are utilizing these secrets. A self-directed IRA is no different than any other IRA or 401k that you might be familiar with now. A self-directed IRA, which by the way, self-directed is just an industry term, indicates to you as an investor that you can take control of your own financial gains. You can take control of your own retirement account. So if you have a 401k, you have a 403b, you have a 457, maybe you work for the federal government, you have a thrift savings plan, you leave that employer, you retire, you can move that over into a self-directed IRA. You can also make contributions to self-directed IRAs, just like you can at a local bank or other financial institution. Again, I mentioned before the Roth IRA. Again, this is one of the most powerful wealth creation tools afforded to us by the federal government. This account allows us to put money away after tax, grow wealth tax-free through investing in what we know and understand. For our clients, that's real estate. And then when retiring, after the qualified retirement age of 59.5, taking money out of that Roth IRA and not paying a single dime in taxes. Now, you do have to make sure you follow the rules. There are rules associated with using these tax-preferred accounts. But so as long as you do things properly, all of this wealth can accumulate tax-free for the rest of your life and potentially for the rest of your children and your children's children's lives. Now, Equity Trust Company, we are a passive self-directed IRA custodian, so this is for educational purposes only. And we encourage you, if you decide to self-direct your own retirement account, that you speak with your own tax advisor, CPA, attorney, or other financial professional. Again, this is for educational purposes only, just so you can understand these techniques that our over 130,000 customers are currently using. Okay, in just a minute, I'm going to talk about how to save $10,000. For those of you that are joining us now, again, my name is John Bowens with Equity Trust Company, here sharing with you how you can eliminate taxes from some of your real estate transactions. Now, I talk a lot and share a lot with a number of individuals across the country on these different techniques and strategies, and there's a lot of different ways in which we can do this, but it all can be broken down to 3 simple steps. Okay, I'm going to share those 3 simple steps with you. The first step is manufacturing tax-free dollars. If you have a pen and paper handy there, I recommend writing this down or taking notes on a notepad. Number 1 is manufacturing tax-free dollars. We can do that by moving over our current IRAs into a self-directed IRA. We can do that through contributions, and we can do that by instituting many different tax-exempt accounts under the provisions of the tax code. There's a traditional IRA, Roth IRA, there are small business accounts. There's even a Coverdell education savings account and a health savings account that you can self-direct into real estate. Allow you to invest in real estate in a tax-preferred environment and receive, if possible and done correctly, added diversification. So the first step in the process is manufacturing tax-free dollars. The second step is putting those tax-free dollars to use. Now, to go back to step 1, manufacturing tax-free dollars, how do we do that? We roll over funds from an existing account, we make contributions, we can make contributions even for our children's accounts or our parents' accounts. Okay, so a number of ways in which you can do that. So step 1, manufacture tax-free dollars. Step 2, put those tax-free dollars to use. How do we put those to use? We look at what we know and understand, what we feel we have more control over. Do you feel as if you have more control over the stock market investments that you're choosing? Some people would argue that they do. For many of our clients, they choose to take control by investing in real estate, investing in notes, investing in tax liens, investing in private equity ventures, investing in precious metals like gold and silver, invest even some of our clients in very unique opportunities, such as tropical tree farms and alpaca farms. So a lot of different things that you can consider with a self-directed retirement account. Again, taking control of your own financial future. Okay, so step 2, again, was putting those tax-free dollars to use. Step 1, manufacturing tax-free dollars. Step 2, putting to use. The third step, which we're not going to talk very much about here, is creating a legacy. And what this means is, who are you selecting as the successor beneficiary to your IRA account? For instance, with a Roth IRA, for me personally, well under the age of 59 and a half, fully maximizing my Roth IRA investments, primarily investing in real estate with that Roth account. If I pass away later today on my flight to Albany, New York, what's going to happen with that Roth IRA? It's going to be left to my significant other, and it will be 100% tax-free to her. Even though she's well under the age of 59 and a half, she won't pay a single dime in taxes because the Roth IRA is seasoned with me. Now let's take my father, for example. He's 60 years old now, has a Roth IRA. He can contribute up to $6,500 per year. We can invest in real estate, growing wealth. Let's say in 10 years, my father passes away at the age of 70. He leaves the account to me. It's seasoned. It's all tax-free to me. Or maybe tax-free to the grandchildren. So there's a lot of different strategies we can use when we're creating a legacy. So again, those 3 steps are from the very top. Number 1, manufacturing tax-free dollars. Number 2, we are putting those tax-free dollars to use in things that we know and understand, investments we know and understand. And number 3 is creating a legacy. Now, in just a second here, I'm going to talk about the hypothetical example, how to save $10,000 in taxes. Before I do that, I want to reference one of the best books that I've ever read in the financial planning arena. It's called The Power of Zero. The Power of Zero is written by David McKnight, and the foreword was written by a financial planner by the name of Ed Slott. Again, the name of the book is The Power of Zero. And the common theme throughout this book is how to have a 0% effective tax rate in your retirement years. And if you structure things properly, you can effectively do that. And a big part of doing that the book talks about is using a Roth IRA. And there's even references in many books across the country in financial planning about self-directed Roth IRAs and different ways to do this. So again, that's the power of zero. Think about how you could potentially create a system and a structure that allows you to retire and live a totally tax-free lifestyle. Now, what I'm sharing with you today does not guarantee a 0% effective tax rate, okay? Don't get me wrong. You have to work with your other financial team members, okay, to institute these types of things. Again, this is for educational purposes only. But if you do things right, you plan properly, 0% effective tax rate in your retirement years. Okay, so let's go ahead and get into the example. So let's say, as a for instance, I buy a property, full acquisition and rehab of the property is $50,000, okay? So a $50,000 all in, again, purchase and rehab carrying costs, all in purchase of $50,000. And let's say in less than 12, let's say in 6 months' time, we sell this property for $100,000, okay? Now, in this instance, we're saying that this is outside of an IRA. Okay, so what I'm describing here is I'm contrasting doing deals inside and outside of an IRA. Okay, from a tax perspective. So in a non-IRA environment, in a taxable environment, I buy a property, again, full in purchase and rehab of $50,000, and I sell it 6 months later for $100,000. I'm recognizing a $50,000 profit. Okay. Now, in a non-IRA environment, this profit is going to be subject to taxation. So I do, in fact, have to involve my silent partner. Okay, we refer to that as. Okay, so the government is going to receive a percentage of that transaction, if you will, in taxes. Okay. Now, let's use, for this hypothetical scenario, a 20% effective tax rate. Okay. So if we take 20% of $50,000, what's 20% of $50,000? That's $10,000, okay? So I pay $10,000 in taxes. That goes directly to my silent partner, okay? Now, that leaves me with how much buying power for the next deal? That leaves me with $90,000 in buying power to apply for my next transaction. So $50,000 purchase, sell it for $150,000 in net profits. 20% of $50,000 is $10,000 in taxes that I pay, and that leaves me with $90,000 to put towards my next transaction. Okay, So now on this next transaction, we're going to do the same thing with an IRA, okay, a self-directed IRA. So let's say, for instance, we have $60,000 sitting in a 401k from an old employer. We move it over into a self-directed IRA. We got $60,000 available for investing, and we're going to do the same. We're going to buy that same $50,000 property. Again, all in, purchase, carrying costs, rehab, etc. All right? We sell it for $100,000. We recognize, as in the same example before, $50,000 in profit. Okay, now the difference in this case compared to this case is we eliminate our silent partner. Okay, so we're eliminating our silent partner. Okay, we're taking that piece and we're sheltering it in the IRA. So we have $50,000 in profit, which is going to be tax exempt. Depending on the type of IRA you have, it'll either be tax deferred or it will be totally tax-free in the instance of using a Roth IRA, so as long as everything else is structured properly. Okay, so you have $50,000, you have the $100,000, and you have $100,000 in buying power, okay, compared to over here where we only had $90,000 in buying power. Now, if we stretch this out over 10 deals, that's $100,000 in taxes that we paid over those 10 transactions, $100,000 less of buying power that we have to go out and do more deals. Now, to add to this, add an additional step. And for those of you who are just joining us, again, my name is John Bowens with Equity Trust Company. I'm sharing with our Facebook Live audience today how you can take your real estate transactions that you may already be doing or looking to do and do them in a tax-preferred environment or tax-efficient environment. Okay, so going back to what we're talking about here, to add another layer to this, you can do other types of alternative investments. It's just not property purchases. Maybe instead of flipping this property or rehabbing this property, as some refer to that as, maybe we rent it out. Let's say we rent it out for $1,000 a month, okay? So $1,000 goes back into, let's say, a non-IRA, all right? And I'm going to have to pay taxes on that $1,000. Or with my depreciation write-offs, eventually I'm going to have recapture depreciation. But in an IRA, I have $1,000 coming back in every month, and that $1,000 is going to grow tax-free. And then eventually when I sell that property, I also avoid paying taxes, all right? Or maybe I'm in the business of private lending, or I'm doing hard money loans with my IRA. So if I loan, let's say, $100,000 and I'm writing that note 10% interest, and I get 10% interest on that $100,000, that's $10,000 in interest income that goes back into the IRA. That's $10,000 that otherwise would end up on my 1040. So what we're talking about here is how potentially investors can divert income that would otherwise end up on the 1040 and now sheltered in their tax-exempt account. Again, the account that I talked about at the very beginning of this session was the Roth IRA. And I would challenge all of our viewers, for those of you who are just joining us now, again, my name is John Bowens with Equity Trust Company. I encourage you to start investigating the Roth IRA. Okay? That is an account that allows you to invest in real estate, invest in other alternative assets, or even just stocks and mutual funds, and grow wealth tax-free. And when you pass away, leave it to your children, leave it to your grandchildren, or your other loved ones, and they can also potentially avoid taxes. Okay, so very powerful strategy. Last but not least, I want to mention that there is the possibility, okay, of partnering your IRA with a Roth IRA, your traditional IRA with a spouse's Roth IRA, your Roth IRA even potentially with your real estate business. Now, I will mention you have to proceed with caution. You have to work with the right legal advisors to do this, okay, because it's a more advanced strategy. But let's say, for instance, you buy a $50,000 property and you want to fund $50,000 of that property with your IRA. So $25,000 of that $50,000 property you're gonna buy with the IRA, and then the other $25,000, the remaining $25,000 to make up the $50,000 purchase, you fund with your real estate investment LLC. So you're going to go into a tenants in common arrangement where your IRA has 50% equity in the deal and your LLC has 50% equity in the deal. And then going forward, all of the profits and all the expenses will flow 50-50. Okay, so that's a way where you could simultaneously grow wealth, tax exempt in your IRA, and then also taxable in your non-IRA accounts. Okay, now remember, you do have to proceed with caution when you invest in those types of transactions because you are partnering with yourself, and under 4975 of the tax code, you are a disqualified person to your IRA. But we can talk about more of those details offline. Again, I want to thank everyone for coming out and listening in to this Facebook Live session. We'll have many, many more of these to come. I would encourage you to like our post, comment on our post, ask questions. We can follow up with those questions. I do want to encourage all of our viewers, if you are interested in learning more about self-directed IRAs, we do have an educational kit that we put together specifically for this live broadcast. And it's right down here. It's www.trustetc.com/live. Again, that's trustetc.com/live. I recommend going to that web page now and downloading the information that we have to share with you. We can get in contact with you and we can talk more about your specific situation and how you can utilize these self-directed IRAs to potentially save on taxes on your next real estate investment transaction. Again, the idea here, as we talked about at the very beginning, going back to that three-step process. Step one is manufacturing tax-free dollars, establishing the self-directed IRA, getting it going, and moving forward, you move into step two, which is putting those tax-free dollars to use, taking control of your own retirement, looking at what you know and understand, whether it's real estate, hard money lending, investing in private equity, investing in various alternative assets, and then last but not least, creating a legacy. Who will you name as the beneficiary to your IRA, particularly Roth IRA, and how you could potentially create a system which allows you to retire and have a 0% tax rate. Again, the website here is trustetc.com/live. I'm John Bowens with Equity Trust Company. Please go there, download the information. We look forward to seeing you on the next live broadcast.